The global fabric supply chain moves with immense physical momentum, requiring long lead times. When domestic tax policies shift, that momentum meets new regulatory friction. On April 8, 2026, the Inland Revenue Department issued a notice that shifted the compliance landscape for all imported fabric. This document confirms that the zero-rated value-added tax previously applied to imported fabric has been rescinded. Financial controllers and supply chain managers must now incorporate an 18% standard VAT into their pricing and compliance models to avoid financial penalties. This is a transition away from the border-centric tax model toward a domestic VAT system that tracks goods through the entire local economy. Historically, revenue from fabric was captured at the border through a CESS levy. This strategy consolidated the tax burden at the point of entry, which meant the commodity did not trigger standard VAT during subsequent local market sales. As of April 1, 2026, the framework changes. The CESS levy is replaced by an 18% VAT at both the port of entry and the point of local supply. This extends compliance deeper into the supply chain. Moving from a one-time border CESS to an 18% VAT alters the cash flow timeline for every fabric manufacturer and importer in Sri Lanka. The process of moving a commodity from a zero-rated status to an 18% liability required a coordinated series of legal changes. First, the Ministry of Finance rescinded the 2018 Gazette that had originally exempted fabric from the VAT system. Simultaneously, the Ministry of Industry removed the CESS levy to prevent overlapping tax liabilities at the point of entry. These two gazettes, issued just a week apart in March 2026, cleared the existing regulations to allow the Inland Revenue Department to apply standard VAT rules. The removal of the CESS levy was the necessary step to bring fabric under the broader 18% VAT framework without doubling the tax burden at the border. The Inland Revenue Department defines the resulting operational requirements in the final section of its notice. Directive 01 mandates the application of an 18% VAT at the point of importation. Directive 02 applies that same 18% VAT to the subsequent supply of that fabric within the local market. This creates a continuous chain of documentation that must be maintained from the moment the fabric enters the country through its final sale. Under these directives, fabric is now treated the same as other standard taxable commodities, ending its previous specialized tax status. However, industrial warehouses do not empty out the moment a new regulation takes effect. This creates a conflict for goods imported before April 1. That inventory has already been subject to the CESS levy at the border. If the new directives were applied to this older stock, selling it locally would trigger an 18% VAT on top of the CESS already paid, resulting in a double tax. To address this, Directive 03 provides a grandfather clause, exempting CESS-paid inventory from the new VAT when it is sold locally. This requires management to track two different tax statuses for the same types of goods, depending on their date of entry. This exemption is strictly contingent on a firm's ability to provide clear documentation. In practice, separate records means maintaining distinct inventory ledgers that categorize fabric based on whether it was imported before or after the April 1 cutoff. The burden of proof rests with the financial controllers to demonstrate to auditors which specific rolls of fabric are exempt from the VAT. Failure to maintain this segregation will likely result in auditors applying the 18% VAT to all inventory by default. While the goal of these changes is a more direct tax structure, the transition requires precise inventory tracking to manage the shift in liability.